Hey everyone, it's Mike from Orderflows, and welcome back to my channel. I'm glad you could join me for today's video. We're going to be talking about market exhaustion prints in the market. And, this is actually one of my favorite trade setups that, when I first started trading with Orderflow, I would look for. All right. So before I jump in, if you've been enjoying learning from my videos, don't forget to subscribe and click the notification bell so you don't miss any new uploads. And if you find today's video helpful, be sure to hit that like button for me and leave a comment sharing your biggest takeaway. I love hearing your feedbacks, and oftentimes I do make videos based off of the comments that you leave, people asking a specific question. And, oftentimes I get questions, what's the best setup to take in order flow? And honestly, the market is dynamic in the sense that there's different little nuances that you see daily, day in, day out. But there's certain things in the order flow that when I see it, I have a pretty strong conviction of a trade. So let's jump into today's topic. All right, market exhaustion. And yesterday, when I was doing my weekly live group training for my order flow users, a question had come up about how quickly can someone learn order flow? Well, and then the question expanded onto how long did it take me to learn order flow? And I explained that I had already been in the market. By the time the footprint chart came around, I had already been in the markets already. I'd been electronic trading, off the floor on the native Globex terminals from the exchanges. And, so I was in a sense all that time already following the order flow. Now, the order flow, because you'd have to work nights, right, to trade the electronic sessions back then. So, I'd come into the office around 10:30 at night and leave after 8:30 in the morning. S&Ps, this was even before the time of the minis. The regular S&Ps would close at 8:15, then reopen at 8:30 in the pit. But the volumes that would trade overnight is nothing compared to the volumes that you got now. So, it was a bit easier to watch the depth of the market, right? Watch, see what's in there. It wouldn't change that much in the middle of the night, honestly. I mean, once Europe opened up, yeah, obviously more activity. And then, into the morning, by the last, from about 6:30 to 8:15 was the busy time. But there were certain things that stuck with me during those times, and it was really reinforced by Tom DeMark. I used to work with his nephew back at Dean Witter, and I remember Tom DeMark had said something. It was in one of his seminars, because the one nice thing is I was able to go to his seminars for free back then. He had said, when the last buyer has bought, look for the market to reverse. Or if the last seller has sold, look for the market to reverse. And when I first understood, a footprint chart, this is over 10 years ago, seeing the volumes, then it really became very clear, as opposed to watching time and sales, because time and sales moves fast. In the old days, it didn't move as fast as it moves now, but you could see what the volumes traded at a particular price. And to me, this was like earth shattering, so to speak, in the sense that, you could actually have it on your chart, on your footprint chart. And when I was trading, even before we started up order flows and all that stuff, and I was trading on a footprint chart myself, this is one of the things that I would look for specifically. And especially, in the currencies, you don't get them as often in a market like the E-minis, just because it's trades a lot more volume. But, majority of markets, currencies, crude oil, the metals like gold, you could see that in there, grains even. And it's what we term as the exhaustion print. We used to call it small print, 10 years ago. We've sort of changed the name to exhaustion print to accurately reflect it. And really what you're doing is you're looking at the edges of candles. What's the volume coming in? And where do you want to look at these? Well, after a move up, if the last buyer has bought, what do you expect the market to do? You expect it to reverse, right? Just as, if a market is selling off and the last seller has sold, what do you expect the market to do? You expect it to rally, right? Because there's no more selling pressure on a move down, or there's no more buying pressure on a move up. Okay, and I would just spend the day, looking at the footprint chart when it's before we had the Orderflows Trader software, because I wasn't even, I was just using someone else's footprint. And I just sit there. I would specifically look for these situations where I get this volume up here, one contract. Okay, down here, one contract. Now there was a one here. Okay, started to go up. Still just a little bit of selling. Market came down, then boom, you get your next signal here, and then the market has a nice rally. And this is sort of how the Orderflow Traders software came about, is because I remember sitting there thinking, this sucks. It's like I got to keep my eye on the screen. Why can't I have a software that does it for me, that just highlights it to me? Okay, and in the Orderflow Trader software, right? That's why we have all these functions in here, right? These are functions that I created based on my own trading experience that I'm looking for in the market. And exhaustion prints right here. Now you can set your limit. I would set at 1. Draw it until tested, just to highlight it out. You click apply, and it just makes it much more visual, right? To a trader, you want to see these things as soon as they happen. It's not necessarily a red light, green light system, but more of a whack upon the side of your head system saying, hey, don't miss this. So if I'm watching the market and I see the market, here we are going up, pulls back a little bit. Here you got exhaustion print there of one contract, pulls back 1, 1, 1. Okay, this one, yeah, I probably would have taken as the market starts ticking back up. This one, no, because it doesn't go any higher. But if I took this first one, yeah, you'd stopped out, fine. Because where are you going to place your stop? Just behind this other line. Because if you're saying this is exhaustion, right, this one contract is exhaustion, if we trade below that, it's not exhaustion. Okay, but you're not just getting long because you have an exhaustion print. You still want to see the order flow start to tick up in the next couple of bars, which it does. So yeah, it gets stopped out here. This one, market doesn't tick up, so you're not taking that trade. You do get stopped out on that first one. But then again, you get this next one here, new swing low. This one's not really even a swing low, but this one is. Start ticking up. That's your go sign, right? You take the trade, market rallies up. You get up here to a swing high. One contract trades, okay? So if you're long from there, this is your sign to get out. The market starts ticking down. Even in the next bar, another exhaustion print, and the market sells back off down to where you had that exhaustion print earlier, okay? Here's another one. I mean, I'm not necessarily a big fan of taking these in the middle of moves. I like it when a market had just made a move, and then you see them popping in. If there's any more later after that. I mean, this one came in. Here was a new high right here. Market starts trading down, but then it just goes sideways, so that's not one you're going to take. And again, this is euro currency. Now, other markets, British pound, for example, today, British pound, I mean, Bank of England sort of surprised the markets, I guess, by keeping rates unchanged for the first time in 2 years. These central banks, in my opinion, they do communicate with each other. Obviously, the Fed did nothing yesterday, so we had that big sell-off here today in the pound. Where is it? Boom, right there. But afterwards, right, you see the market goes up, pulls back. It's not a swing low, but in the bar right after the swing low, again, I could accept it that it's coming in on the bar right after the swing low. Okay, get a nice little rally, put in a swing high, exhaustion print there, but that's a little far removed. Again, another swing low, another exhaustion print right here. And you start seeing these exhaustion prints, and then watch what the market does after it puts it in, okay? Because that's going to give you your clue. Let's take a look at crude oil today. I haven't looked at crude yet this morning, but let's just take a look, pull it up. Okay, and you can see right here, right? Is this a swing high? Well, that's your swing high. Again, a couple here. Again, I'd much rather prefer it at a swing high like here or here, but right here is kind of in the middle of sideways activity, right? You want to, people always say, trade in context of the market. Well, okay, this one would you take? Well, again, it's yeah, you just made a new high. It's 2 bars later. I don't know. I'd rather it be right on the high or the bar afterwards. That's just me. You know, here you get a little bit of a pullback coming in right here. It gets a high, starts coming off. But like I said, in a market like E-minis, okay, now the one thing to note, I do have this one set pretty tight at just one contract, okay? And so let's see here. Okay, so it's a one contract, right? One. Now, you could adjust it to whatever you want, right? So on a market that trades more volume, like E-minis, right, one is going to be difficult because it just trades a ton of volume compared to the euro currency or British pound. So if you were to change it to, you know, you can change it to 5, right? You can see here, limit means the volume. You know, originally when I would used to use it, you know, 10 years ago, I had a volume of 10 or 9 rather, but to just show you, right? You can set it to a level like 5. I mean, you could use 10 if you want, but in this case, I'll just set it to 5. And again, you know, where's the cash open? Right here. Okay, going down, not a swing low, kind of a swing low here. Technically, since the cash opened, okay, market starts going up, and it's just sort of going sideways. Then it starts falling down again. Okay, would I take this one? Again, here's a 6, but it's not. I set it at 5. I was not giving you a signal. Then you get down here. Okay, so even if you took this one, okay, it goes up, comes down, trades down through that level, stops you out. Fine, live with it, deal with it. Lick your wounds. Look for the next trade. Here on the low of the day, 43.98 3/4. First time you trade 45, second time 44, and then 4. So you keep pounding into this low. Selling is getting a bit lesser and lesser. Okay, he leaves that exhaustion print, and you get this nice rally all the way, you know, almost all the way up to 14. Okay, yeah, you get a swing high here. 2 bars later, you get that 3 or 4 rather. You see the market sold off. Now, if you're trading a much more liquid market, 10 years trades a ton of volume, right? I mean, volume at a lot of these prices. The wrong 10-year symbol there. Just bear with me, ZN. But I like to use a 4-range chart. The reason being I like to use a range-based chart on a market like 10 years is because of this, right? It's just a lot of trading the bid and the offer, right? 2 price levels in a bar, and it just, in my opinion, doesn't give you a whole heck of a lot to go off of. That's why I've always used, say always, but over the last 10 or 15 years, a 4-range chart in treasuries. Okay, here you had a 2 right off the low. It starts going up, going sideways, but you can see the selling pressure in this case sort of building up again, that we may go lower, right? You can see 11,106 finally breaks through 6,000, almost 7,000 contracts into the new low, and then bounces back up. But you can see here, since last night, right, the reopen trades 4, okay, sells off, comes back up, sells off, comes back up. This swing low here, or sorry, swing high, lower high. But in the next bar, you get a 1 contract trades. 4,955 contracts in this bar trade, you only got a 1, right? And again, you can see here yesterday, right? Low of the day, new low of the day, 5 contracts, shoots straight up. Okay, that was during the Fed announcements, but you sort of get the idea now of what you can look for in exhaustion prints, and you could set it to whatever you want. So on a market like, you know, this is 10 years, right? Maybe you don't want to use 5. You know, maybe you want to use, you know, a higher number. I mean, you can set it to whatever you want. Actually, you know, honestly, you could set it to, pull it up here. I mean, you know, if you wanted to, you could set it to 50. Now you're going to get a bunch more signals, obviously, at 50 because it's quite strong. All right, you can see here. right here, going up. Obviously on the way down. But again, you can set it to whatever you want based off of the market that you're trading, the chart type that you're trading. But really what you're looking for is that exhaustion, right? Really quick. So I'll just show you, HE hogs. Okay, I'm not going to set it to 50 on hogs, but people are like, well, hogs, who trades hogs? Actually, some of these markets out there, they're worth a look at, right? They're not as active as, say, obviously as E-minis, the volume is much lighter, but you can sort of see these things. I mean, it's right off the open, one contract, to the low, one contract, swing high, one contract, right? It's just fascinating how it works in the sense of identifying exhaustion. Now, again, this is a very thin market. Okay, so once you understand that, you get the idea, right, of how to look for exhaustion. You're looking for the last trader to trade. So anyway, guys, I don't want to go any down any rabbit holes for you guys that you don't want to go, but we'll end it there for now, and I'll catch you guys on the next video. So if you haven't already, be sure to subscribe to the channel. Take care, everyone. Bye-bye.